Mr. Chairman and Madam Chair, thank you so much for being here. I am aware that there is an accumulating amount of research and scholarship, as a matter of fact, kind of tracking the long-term decline of entrepreneurship and business formation. Fewer businesses are being started and fewer are living past the first or surviving past the first year. And as we all know, there's a declining number of community banks in this country. So my question to you is, what can you do and what can we do to help community banks serve their local economies?
Well, community banks are really vital to local economies. I've seen this firsthand when I was in San Francisco and president of the Reserve Bank there. It's something we're very focused on at the Federal Reserve. We want to see community banks thrive and know that for many different reasons, this is a very difficult environment for community banks. The slow pace of economic growth and recovery that we have had, the low interest environment is squeezing their margins, and the regulatory burdens that they face have been really quite high, and they're struggling with it. For our part, we're looking in the way that we supervise community banks to do everything within our power to reduce the regulatory burden. And I could give you a list of things that we are doing to try to minimize the burden: more off-site exams, more special tailoring of our exams to the risk profile of the bank.
If I could reclaim my time. Thank you.
Sure.
Kind of in the spirit of this, Congresswoman Beatty asked you about what you could do specifically to help communities of color who have disproportionately high unemployment rates. And you indicated that you don't have specialized tools. I'm going to respectfully disagree. Okay. And I would encourage you and others at the Fed to take note of some recent research done by a graduate student at MIT named Mr. Yellen, who indicates that when community banks branches leave census tracts where there is a concentration of either low income or communities of color, that local business lending declines precipitously, even when there are other national or international bank branches retained in that community. He tracks that it's not true with mortgage lending, but it is true with small business lending. And with all due respect, Madam Chair, you have merger approval authority oftentimes when community banks are purchased, and could make conditional the continuing presence of branches in those census tracts or in those neighborhoods where we have begun to document a decline. So with the little amount of time I have left, I'm always interested in your opinion about what you see as the threats to our continuing recovery. And I will use this opportunity to suggest that I don't think it's as robust as it can be. You and I have had the conversation about the output gap and the dire need for the Fed to begin to think of itself differently as it relates to investment in infrastructure, but I'm not going to go there today with you. What do you see as the threats that could induce, or the factors that could contribute to another downturn in the economy? What are you worried about? What keeps you up at night?
So let me first start by saying that I do think the economy has improved a great deal, and in a way I'm focused on the economy's strength and its good performance rather than mainly lying awake at night and worrying about a further downturn.
But the Fed has reduced the projected growth rate of the GDP by 20% in just the last few years. From 2.5 to 2.8 to 2 to 2.3. That's a material downward projection. But the question still is, what's out there that worries you?
Okay, so let me just say that the writing down of our projections on growth in part reflects the fact that productivity growth has consistently disappointed now for a number of years. So our unemployment projections have proven more accurate than our output projections. In essence, we've had decent job growth and better job growth than you would have anticipated, or we would have anticipated, with weaker growth. So in part, it's a reflection of quite disappointing productivity growth.
The time of the gentleman has expired. The chair now